Hey guys, so I want to talk to you about something that quite often gets brought up. And when it does get brought up, news articles and media crawl all over it because it gets clicks and attention and everything else like that. But it's essentially a big market crash. So, a 20-30% market crash where the whole property market essentially collapses and we start to lose property values. We start to go into negative equity, sort of Armageddon, worst case scenario situations. It's something that, when you think about it and when you see it in the media, it's scaremongering. Like you do feel like, well, what's going to happen to my portfolio? Am I going to be financially unstable? All those questions start to come to mind. And even me as a property strategist, I still think about those things because they word and phrase things in a certain way that makes you think like that. But I want to walk you through, we're over on the Game Plans platforms here about what would happen in that scenario and how your portfolio would perform over the long term based on that scenario. So I'm going to take you through a real world example of someone who has a current portfolio now. I think it's around the sort of $1.7 million mark. We're going to add a property to the portfolio today with the thought process of two major market crashes over the next 30 years. Now, it's commonly said that, a property market cycle historically has been sort of 7 to 10 years. A lot of experts these days are saying a full property market cycle is sort of closer to 10 to 15 years at this point. And so the Game Plans platform forecasts out for the next 30 years. And so we're going to account for two major market crashes over the next 30 years. As a bit of a baseline, though, we are growing at 5% per annum. So that's going to be factored in apart from the years that we're going into negative growth. We're going to be growing at 5% per annum after that. With a 4% rental yield from there as well. And then a whole bunch of other assumptions that we've got here, which you guys can all come in and put in your own assumptions and play around with these things. I've talked about them in multiple videos beforehand, so I'm not going to go through everything today. But 5% growth in the years that there isn't market crashes, and then two major market crashes from there. Again, the Australian property market's performed at 6.8% on average over the last 25 years. So using a 5% compound growth rate there is quite low. And when you sort of picture that 6.8% on average, that means that there's much more properties above that 6.8% that we'd consider investment grade assets. And then a lot of properties underneath that, which we'd consider, investment stock or not investment grade assets. And so, when we are being property investors, we do want to go for that good stock anyway. So worst case or medium case is sort of 6.8%, but we're even taking 5% here. So as I mentioned, this portfolio, it's a $1.7 million portfolio based on just 5% growth over the next 30 years. It's going to essentially compound to a $7.6 million portfolio over that time horizon. Now, in terms of passive income, at the moment, it's generating about 10 grand passive income per annum. And then over 30 years, it'll end up being 106,000 passive income over those 30 years. Now, looking at this person's particular goals, they've got a passive income target of 150K. So they're unable to achieve that, hitting that goal. So let's say that, we're now in November 2021, look at doing another purchase next year. Let's just say it's a high cash flow purchase because this person's really looking to hit those passive income targets. So let's just put in another $600,000 purchase. It's a resi at 8%. We're going to cap the growth at 5 and rental yield at 4 there. And we'll chuck that purchase in. By doing that, our market value gets to about 2.4, and then we're compounding that to about a $10.1 million property portfolio. Our savings and equity is quite comfortable by doing that purchase. However, we're now hitting around that sort of 140K. So you could even bump it up to 700K purchase, see how that would take us. Savings is still fine. We're dropping another 30K there. And we're essentially just touching that 148,000, call it 150 from that side. So we're doing another purchase next year. We've got a $2.5 million portfolio that compounds to $10.5 million over 30 years with that passive income being achieved. So 4 properties within the portfolio, roughly $2.5 million. And then let's say Armageddon happens in 2023, interest rates go up like crazy, and the property market essentially comes down. We're going to override the entire portfolio growth in this year, and let's say that there's a negative 30% growth. So really Armageddon style here. What that does is essentially takes our portfolio from 2.5 down to a $1.7 million property portfolio. And then if we go back up, compounding at 5% from there, we still get back up to around a $7 million portfolio from that side of things. So, not as sort of strong as 10.5. We're sort of losing $3 million over a 30-year time horizon. However, we're still going from sort of 2.5 to 7 million over that time horizon. And the passive income side of things, I mean, let's increase interest rates here. Let's say that they go up to 5%, something like that. It's going to essentially take our passive income from 10,000 down to negative 25. So we're actually losing sort of 35 grand there just from the interest rates increasing. However, if we can sustain that period of negative income, we'd essentially still pay down that debt, and we end up hitting that passive income target over that time of around 148, because we'd have no debt, which means we're not paying interest repayments, and our rental income is going to be still the same at that point in time, 4%, and then 4% on entry, I should say, and then increasing at 2.5% per annum after that. So we take a hit of about 800, 900,000 maximum on the portfolio after that point in time. But we still increase that or compound that to a $7 million portfolio over 30 years. Now, let's say that we get hit again a couple of years later. Let's give ourselves some breathing time. Let's do another whole market cycle. We'll go from 2023 to 2038. 2038, we'll have about a $3.7 million portfolio. So if we go into our annual spends, 2038, and let's do another 30% market drop. Another 30% market drop there. Our portfolio essentially goes from 3.5 million down to 2.4 million. So we're less in sort of 16, 17 years time than we were when we purchased that portfolio. So 2 major market crashes. However, we still compound the portfolio to around a $4.6 million portfolio. So we're just under doubling our portfolio size over 30 years with 2 major crashes. At the same time, we're still able to pay our debt down on a 5% interest rate by 2043. So that's over 20 years or so. And our passive income side still remains the same. Even if our interest rates increase to, let's even take them up to 6% or something like that, the worst it really gets to is sort of negative 40. And then we go positive again by 2029. So from a portfolio perspective, if, you're not sort of treating your property as a share and, reviewing its price every single day, you're still going to have a $4.6 million property portfolio over 30 years, which, yes, it's less than half of a $10.5 million portfolio that we had at the start. However, we're still better off in terms of equity within that portfolio. The biggest thing that we should be careful of really is, regardless if there's a property market crash, if it's caused by interest rates, we are going to have a hindrance on our cash flow of about negative almost 50, 60 grand from where we start at positive 10. So it's going to have a huge impact on our cash flow if the crash is caused by interest rates. And we do have to sustain that portfolio on those interest rates. However, we end up paying that debt down over time anyway. So, if we can hold on to the portfolio for a good 10 years, equity position, yes, we're going to, cop about $5 million worth of equity that we won't get within the portfolio. But we still do have that passive income coming through quite strong as we head into the retirement stage of life. So, I mean, this was a question that sort of beckoned to me as I sort of see the Chris Joys coming out with these sort of statements of major property crashes and, the common names like Martin North and all that sort of stuff. When I was younger and building up my portfolio and would watch his content online, I'd sort of, get really shocked about, oh no, I've made a mistake investing in property. And, these things do happen. They've happened in other countries. They've happened across the world. We don't know when they might happen. People have tried to forecast every year on the year since they've come out, and people have been wrong every year on the year since they've come out. It can happen. It might happen. And this is what happens if it happens. This is a 30% crash, which is huge, which is completely huge. So obviously there's going to be a lot of other implications that happens when the property market crashes that we might not have accounted for here. We've only really just done value and interest rates increasing. We might have a rental shortage, which will drop rental yields and all those sorts of things that may happen. It is a bit of a spiral in an economy. So some things might sort of change and chop as we go here, but just looking at the value of property, we essentially lose half of the value that we would have had in total equity over that time. And we're going to have a period of sort of 9 to 10 years there where we need to be able to sustain and hold onto our portfolio. And as long as we have those strong incomes coming through and can sustain, have cash buffers on hand to account for those worst case scenarios, then we should be able to sustain that portfolio until it goes back into the positive mark. And then we're still hitting that passive income over that time anyway. So big question out there about what ifs, property market crashes and everything else like that. But, period of unsustainable growth, get used to it. We're going to lose a bit off the top of the portfolio, but we're still going to be making money over that 30 years. And then we're going to have a bit of a tough period with a passive income, with the view of it still becoming positive over that long-term time horizon. Hopefully that sort of gives you some clearer insights and some understanding of what might happen in the worst case scenario. And maybe you can jump in on your own portfolio and have a bit of a look of what might happen if the market did turn down to a certain number, and have a play around with those sorts of numbers. But anyway, I'll talk to you soon.